Hi, today we're talking to John Bugeja of RBS and Global Transaction Services. And of course, we're going to be discussing, some of the major themes that are going to be going on, being talked about by global experts at Sibos in Toronto, 2011. Okay. So, we've been on kind of a long and rocky road to financial recovery. And, while global trade has kind of largely recovered, there's been a huge changing marketplace, and there's been slow economic growth. Especially in Western countries, that presents a lot of challenges. So why don't we talk about where financial institutions can turn to for opportunities in this current marketplace? So what are some of the emerging trends in trade and FIs and others that we can look to for client retention or new client possibilities?
Interestingly, some of the new trends are actually a resurgence of an old trend. The long-term trend for traditional trade instruments like letters of credit has been negative. Gradually, corporates have been moving away from LCs and so on towards open account solutions, supply chain finance, insurance-backed solutions, and so on. Since the crisis, whilst global trade has picked up and 2010 was generally a positive year, mainly in Asia, not so much in Western Europe, but certainly it was overall positive, there has been a greater interest amongst corporates in the use of the traditional LC. Now, the LC does, as we all know, provide lots of very well-known advantages, settlement, finance, risk mitigation, and so on, and a certainty as to how things work. And as the various bank counterparties have become more risk-aware, that's also impacted the behaviour of our corporate clients. So we've seen a resurgence of the LC. I think it's a temporary resurgence, but nevertheless it has taken place. In terms of opportunity and trend going forward, I think there are a couple of areas that we would look at. Firstly, corporates still don't like using letters of credit because they're seen as costly, slow, cumbersome, and any discrepancy invalidates all the benefits. So whilst they like the benefits, they don't like the process of going through the LC instrument. So one of the trends I think will be to make that pain go away. One of the ways in which we can make the pain go away is by the use of sophisticated electronic delivery channels, which can take most of the pain, most of the paper, and most of the hassle out of opening and processing letters of credit. We also bolt on additional services which can further improve the proposition, such as document preparation, pre-checking, and quite advanced complex MI solutions which enable customers really to manage their portfolio of trade traffic and supply chain finance traffic in a very sophisticated way. All of those things I think we'll see becoming increasingly important over the next year or so as corporates do turn to the LC in times of sort of difficult risk considerations. Those factors can be made available to other banks. So those benefits we can deliver as a global bank. We can deliver those same benefits to another bank's clients through a partner arrangement. Now, partner arrangements aren't new. We've got lots of client banks on our books today already. But I think the opportunity to stretch that proposition and to make that more readily available to FIs generally is there.
Are corporates recently, are they demanding a lot more from their banks now? Are they becoming more sophisticated in their needs?
They are sophisticated. I think the starting position is they don't like letters of credit. So if they could avoid handling the process, they would do. But they do like the benefits, particularly in the commodities world and the capital goods, the heavy engineering world. This is still a very important settlement method. And at the other extreme, the import into the West of finished goods manufactured in the Far East, it's still the predominant method of settlement for the smaller importer because their credit standing and their reputation just isn't big enough to warrant an open account solution. So customers are becoming more demanding because they don't expect to have to spend time preparing requests, poring over shipping documents, having endless debates with the bank about whether a presentation is right or wrong. They want it right first time, they want it quick. So, and they want their cash. If they're an exporter, they want their cash as quickly as possible, and they want finance. All of those things are delivered through the letter of credit, but the pain is what needs to be eliminated, and that's where the electronic channels can come in.
So I wanted to move on to everyone's favorite topic, which is regulations. So what impact will new regulations, current regulations, have on the trade finance industry?
Well, the big new regulation everyone's talking about is Basel III.
Everybody.
And that's a huge, huge subject. There are a number of misconceptions about Basel III, and to be honest, we don't yet know what all of the implications are going to be. But I think most practitioners in the trade finance world are fearful that there will be some unintended consequences. So the direction of Basel III is clearly to make banks safer and better able to withstand shocks. And I don't think anyone would disagree that that's a good thing, especially as trade finance is fundamentally a bank-to-bank transaction. And one bank is invariably taking risk on another bank, therefore making everyone safer is a good thing. But the unintended consequences are that trade finance becomes less balance sheet efficient and more costly and potentially less attractive to clients, and therefore they don't use the trade finance solution, even though that is actually the best way to settle and finance international trade transactions.
So, I mean, although I do predict, I think Basel III will be one of the major topics talked about at Sibos this year. I think another topic people talk about is convergence. So, I mean, will the convergence of trade, of cash and trade in the supply chain, is that the way forward for this industry?
Actually, people have been talking about cash and trade convergence for years. The reality is that from a customer perspective, convergence is essential because customers' needs span a whole range of factors. Some of their needs will be met by a traditional payment or cash or liquidity management solution. Some will be met by a trade finance solution, whether it be a supply chain finance solution or a traditional trade solution. I think the world of supply chain finance is evidence of the banks moving into that space between traditional trade and cash, because it is in the open account space, it is about making payments, but there is a deferred credit aspect and there's a risk aspect to it. What will hold up convergence, I think, in the supply chain world is that the current model for supply chain finance is really focusing only on the post-approval or the post-shipment phase in a supply chain, which doesn't address all the corporates' requirements in managing their supply chain. And there are some obstacles which will get in the way of more broad adoption of a supply chain finance solution. Things like the ability to onboard suppliers, to provide pre-shipment finance to suppliers, and even the scale factor where suppliers are supplying more than one buyer and buyers are operating with different banks with different platforms. There comes a point where suppliers cannot cope with the administration of multiple solutions. But I think there is a potential solution on the horizon which will again be in that space between trade and cash, which is the bank payment obligation, often abbreviated to BPO, and also referred to by the ICC as the ATO, the Automated Trade Obligation. They are the same fundamental solution. We're in deep dialogue at the moment with the ICC and with SWIFT on the development of rules which will be published by the ICC, hopefully by the year end, which will, I think, promote much greater adoption. But the BPO, or ATO, I think will be a very good example of the conversion between trade and cash. It's in the open account space, but it provides most of the benefits of a traditional letter of credit solution, but without the pain. It also means that working with working with sellers is a lot easier because you're naturally working with the seller's bank if you bank the buyer and vice versa. So the adoption issues and the pre-shipment finance issues become pretty much business as usual, almost as if it were a letter of credit, but without the pain of a letter of credit.
Great, thank you very much.
Thank you, my pleasure.